Hi, everyone. How's it going?
Good. How are you?
Voltaire's wrapping up his last call,
Hmm.
so he'll be on in just a few minutes.
Okay.
It's good to see familiar faces. Um, Anything? Everybody's having a good day.
Yeah.
Anybody
So
want to
far, so
share?
good.
Yeah. Oh, let me see. No te. I can't hear Paola. There we go.
Better now.
Yeah.
Okay.
How's your day?
Pretty good. I just finished like 30 minutes ago.
Nice. Great. We're still here
Yes.
at the office. Meanwhile, a lot more people join us. Voltaire will wrap up his call. I'm excited for tonight's class. This is like my favorite um, class we give. It's very informative.
Hmm.
We can't hear you.
You're mute.
All right, can you hear me now?
Yes.
Yeah.
Hello, how you guys doing?
Hi.
Hey, all right, let me connect to audio.
No, I can't hear you. There, I
Okay.
think.
Okay. Now we're good, right?
Yeah.
All right. Cool. Hey, welcome. Thank you. Apologize for my tardiness. So I just wanted to start off by we have a small intimate setting here. So I'm assuming everyone who is on here is a first time buyer or potentially buying again for the first time. So that's what we're gonna be covering today. So the main thing to know is, or before we get started, just kind of like the intro on this is, we're very passionate about real estate, um, and there's many reasons why. Over the last 18 years that I've sold real estate here in San Diego, what I've found is a lot of my clients, I started off with a lot of elderly clients, a lot of people in their 60s. And, I started noticing a couple of similarities between them. They tended to, own, several properties, between 2 to 10 properties, nothing too crazy. And, and for a living, what they would do is just go around the first of the month and just collect rent, you know, kind of like, I just got a rent check right here, dropped on my desk. But, and I started seeing that over and over, and it never really clicked. And around 2010, 2011, that's when it started clicking for me, where I was like, hey, you know what? All this, a lot of these clients that kind of are chilling all the time, they live a pretty good life, right? They just collect rent. They don't necessarily. Some of them had jobs. A lot of them didn't. So that's kind of what started triggering me into realizing how impactful real estate was. Because before that, I was just selling houses. But after about 2011, when I personally started just holding on to real estate, before that, I was flipping, I was doing assignments, I was wholesaling real estate. But after I started holding on to it, that's when it started clicking. And instead of selling houses or helping people buy homes to live in, I started seeing it as this is like kind of the kickstart, their initial investment into future real estate if they wanted to. And I have a really good, actually a really good client. Her name's Tiffany. When we first started working together, she wanted to buy a condo to move into, and I told her, "Hey, this is the first deal we're gonna do, and then I'm gonna help you buy more homes." And she was like, "No, no, I just want this house. I just want to live in this townhome, and that's all I want." And long story short, um, she ended up selling that townhome. She ended up, sorry, keeping it, renting it out, buying a condo. She had 2 properties, and then she ended up parlaying those two deals into a really nice house in Mission Hills. And she started with a condo in Chula Vista. And that's kind of how real estate works. And she lives in $1 million neighborhood. And she started off with a 3.5% down on $265,000 condo. So she started off with less than 10 grand as a down payment. And now she has a lot of equity in a property in Mission Hills that, you know, she's gonna live there for probably ever, I don't know. But that's kind of the power of real estate. I just want to share a couple of brief examples on why we're so passionate about real estate is because we believe in it, we just don't sell it, you know. So that's kind of the intro. So now what I want to do is I'm going to share my screen, and since it's an intimate setting, I want you guys, if you guys have any questions, feel free to just put it in the chat or raise your hand, or you know, and we could, you know, stop and kind of go over the question that you have. Okay, so let me pull up my screen, and that way we could kind of get going here. All right. So here we go. All right. So Claudia, can you see my screen here? Awesome. All right. So let me skip a couple of things. So the first thing to know about real estate, okay, we're going to go over the different steps in the home buying process. Again, for this is the same thing with when you buy your second, third, fourth, fifth home, but we're focusing on the first home. There's two types of agencies: seller's agent, buyer's agent. What's agency? Well, in California, there's agency law, which makes it to where any realtor that you choose to help you, they have a fiduciary duty to you only. Okay. So what's a fiduciary duty? That's a legal term for they have to have your best interest. They can't have anybody else's best interest. They can have their own best interest. I think a lot of realtors get a bad rap for putting their best interest first. They can't have the seller's best interest. They got to represent you, your best interest. So that's basically how agency law works in California. That's the first thing you should know as to how that works, okay? All right. So that's step one. So step one is the home loan pre-approval process. Again, there's different steps in the home buying process. We're going to go over 5 of them. But this is the most important one. That's the first step. Now, there's a lot of people that say, you know what? I'm going to worry about the home loan later. I'm going to go look for homes now. Well, what if they find the perfect one now and they lose it out to someone because they're not approved? Now, the important thing to know about the home loan pre-approval process is that you should get started on it right away. Even if you're not planning on buying, let's say in 2020, you plan on buying 2022, 2 years from now, you should start this process right away, because the lender could get with you and say, hey, you know what? You need to save up a down payment. You need to make X amount of income to buy this type of home. You need to work on your credit. So all these things that may take a year, 2 years to get done, they're going to tell you right now. Okay. So it's always good. It's free. It doesn't cost you anything. So the important thing to know about the home loan pre-approval process, historically, interest rates right now, they're at the lowest that they've been in the history of interest rates. So in the 70s, they averaged 8%, in the 80s, 12%, in 1990s, 8%, 2000 and 2010, 6.29%. And then 2010 to today, they're averaging about 4%. So right now, if you go and talk to a lender, they'll probably tell you that they might be able to get you a FHA or a VA loan somewhere in the 2% range, 2.75, 3%. That's incredible when we're talking about interest rates, when historically, if you look at the average here, it looks like they might have averaged somewhere around 8%. And you're borrowing money for 30 years, right around 3%, 2.75, depending on the type of loan that you're getting. That's incredible. And I think everybody should really take note of that, of how important that is and how amazing that is as far as interest rates historically, okay? you have any questions, again, in the chat box. So interest rates are always up and down, up and down, up and down. So this is kind of where they're at right now. And it's just like home prices. Home prices are always up and down, up and down. So you never know when, where they're going to go. I can't really imagine them getting any lower, just because at that point it's going to be literally free money. And there are some projections from different people, different associations. Okay, so now let's talk about different types of lenders. So there's different types of lenders out there. Okay, there's a mortgage broker, there's a large direct lender, and there's private direct lenders. So what's the differences? Okay, mortgage broker, they're not going to give you the money direct. Where a large direct lender and a private direct lender, they're going to loan you the money directly. Okay, so the difference is, if you go with a mortgage broker, they're going to take your application, go shop it around one of these guys, and then they're going to give you, they're going to bring you potentially the best deal that they found. However, maybe their fees are a little bit more. Maybe they're going to charge you a broker fee. So that's how that works. Now, a large direct lender, you guys are familiar with. So large direct lenders are banks like Wells Fargo, Navy Fed, the credit union, Bank of America, Chase, etc. So these institutions, they let you borrow money and to buy a home loan, but they also do other types of loans. They do car loans, they do checking account, savings account, they do business loans, personal loans. So they have multiple streams of income. Okay, so what does that mean? Well, that means that they're not focused on one thing. That means that they have limited amount of actual programs. So you could go to one of these guys. A lot of people like their credit union or wherever they bank, but just know that they don't focus on just one type of niche as far as home loans. They do other stuff. So they're not going to be as fast. On a lot of products, they're not going to have all the products. They might have like 2 to 5 different types of loans that they do. And they're not going to be as efficient. They work usually Mondays through Fridays, 9 to 5. So if you need help on the weekend, nights, and things like that, it might not be as flexible. Okay. Now, the third type of lender would be a private direct lender. So a private direct lender, they lend you money direct. However, they're not big institutional lenders, and since they're not brokering anything. So with them, they only do home loans. They don't do car loans or any other type. So they only have one source of income. So if they only have one source of income, that means that that's all they depend on. So they do a really good job when it comes to loans. So they have really good processes. They're pretty fast. They work nights. They work weekends. Their rates and costs are in direct line with these other guys as far as large institutional lenders. They're a little bit cheaper than brokers. So they could close the deal faster. So that's kind of like some pros and cons of these type of lenders. So during this time, this is usually when we get a couple of questions where people may be not 100% confident with how this works. Does anybody have a question about the loan process, whether it's interest rates, whether it's the types of lenders, or anything like that? Feel free to, I'm gonna go back a couple slides in case you guys have any questions here. We talked about interest rates. We talked about the different types of lenders. By the way, if you're looking for any type of government assistance, they all have some type, but usually private direct lenders have the most programs. For County of San Diego, City of San Diego, City of Chula Vista, City of National City, where they're able to go ahead and give you some type of help. Question from Guillermo: is 60 days still good base to go off of a pre-approval letter? Who are private direct lenders? Great. So is 60 days still good base to go off to begin for a pre-approval? So I think, Guillermo, is your question more along the lines of, let me see, I don't see you on here. I'm trying to better understand your question. So if your question is, when should you begin as far as a pre-approval, start today and you'll get an approval letter. If you qualify, you'll get an approval letter within a week. How long do pre-approval letters last? That's a good question people ask. Is they usually last, they can last for 6 months, but as long as nothing changed in your credit profile and your income, and you didn't pick up any new debt, you haven't missed any payments or anything like that. What happens is if you're looking for homes for a long time, the lender is going to continue to ask for updated information. They're going to say, hey, I need an updated bank statement every single month. And then they'll just keep renewing your qualification. So again, to get qualified in a pre-approval, it's free, doesn't cost you anything. And you just have to continue to submit the paperwork as you get it. So if we go into the next tax year, they're going to ask for the next tax returns, okay? We have another question. So sorry, just in terms of, oh, is that you, Guillermo? Okay. So Guillermo says, sorry, just in the terms of going to my bank to get a pre-approval once I'm ready to start looking. Yeah, I would go 60 days before for sure, if not sooner. Start working with your bank and giving them all the documentation they require. That way you could get the pre-approval letter right away. And hey, if your ducks are all in a row and in line, then you'll get a pre-approval letter again in about a week. Okay. Of course, my pleasure. So who are the private direct lenders and what are the interest rates? Good. So right now, these interest rates we went over, these are across the board, somewhere in the 3% range to 2.75, depending on type of loan. Whenever you use VA and FHA, it's always going to be cheaper than conventional. VA and FHA loans, historically for first-time home buyers, they have the best interest rates. Anytime you start to tack on, let's say, government assistance programs such as down payment assistance with CalHAFA or the County of San Diego loan products and cities down payment assistance products, your interest rate is going to be a little bit higher. Okay, so it might jump up from 2.75 to 3.5%, closer to 4% if you're going to start asking for down payment assistance. As far as who are the private direct lenders that we're talking about, well, since they're not these guys, usually private direct lenders, they're companies you've never heard of. And the reason why is because they're like in office buildings. You know, you see those office buildings, whether it's in downtown or Chula Vista or wherever, they're usually within a suite in those office buildings. So you wouldn't know about them because they don't have like checking accounts or savings accounts. So there's no reason for you to walk in there unless you're buying a house. So it's usually private companies who have their own money and they let you borrow, or they have direct lines of credits with big banks like these, and then they just use those lines of credit to give you the money directly. So that's a really good question. If you have any other questions, feel free to ask them. Here's another question. Most builders and developers promote their own in-house mortgage lenders. What are the pros and cons to go with these lenders? Great question, Edward. Thanks for that. I would have never even thought to cover that. So most builders and developers, you're right, they do promote their own in-house lender. They have ties with them. Number one, they use them because they feel comfortable and confident that those lenders know what they're doing and they're going to make sure that the buyer gets the loan. The second reason why they team up with them is because they might be giving them some of their profits on the loan. So it just makes sense. It's business. Now, will the pros and cons is this. The pros is usually the in-house lenders offer closing cost credit to the buyers. And the way that they word it in a way to where you, the buyer, believe that the only way you're going to get those, let's say $7,000 for your closing costs or 10,000 or whatever they're offering you, is if you use their preferred in-house lender. So the benefit is you really don't have to try too hard, negotiate too hard on that, because they're just going to offer you that right off the bat. Now, most of the time, the way it works when a lender gives you credit for your closing costs, okay, so if they're offering you $7,000 credit, most of the time, what we don't know as consumers, as buyers, is that if they're giving you $7,000 and they're giving you a 3.25% interest rate, the reason why they're giving you $7,000 a lot of times is because they pad the interest rate. So they could give you a 3%, but they're really giving you a 3.25, and they're giving you, let's say $7,000 for closing costs. So if you say, hey, I got my own closing costs, I don't need your closing costs, then they're usually able to give you a lower rate. So in reality, you could get a closing cost credit from any lender. I think because the builders and the developers really want to use their own lender, it's a little bit easier to get. Now, I've done several deals where my buyers wanted to use their lender, their friend, or whoever they know and trust and love. And I was able to negotiate with the developers and the home builders for them to still give the buyer the $7,000, okay, from the sales price. So good question, Guillermo. Edward, thanks for that. So those are the pros and cons of going with the lender. I mean, really, as far as cons, I can't really think of too many because they usually use pretty legit lenders. I guess the only con is maybe the trust. Because they're not, you don't really know them. You don't know how they're calculating the closing costs that they're offering you. Okay, we have another question. Do they assist you with grants or first-time buyers from city or county? Yeah, so if you want a grant or a first-time buyer program from the city or county, I recommend that you go with a private direct lender, because some of the bigger banks aren't going to have anything. I know, like, for example, Bank of America has a program right now where they're giving you some type of credit. Claudia, would you happen to know what that credit was or no? I can't hear you, but if you don't, that's fine.
10,000.
No? 10,000? So Bank of America has a credit right now?
Yeah, up to 10,000 for closing costs.
Do you remember the name of the program, or is that their own program?
That's Bank of America's funds.
Yeah. So some of these banks, it's rare, but it happens from time to time. Like, for example, Bank of America, they have their own fund where they just say, hey, look, we have access to these grants or whatever, so we're just going to give you some money. Now, they're not going to have access to the programs such as the down payment assistance program with the county, where the county gives you up to $70,000 as a down payment, assisting you with that. So there's those programs where what it does ultimately, if they let you borrow, they're not gifting you $70,000. Okay, that's basically a down payment assistance where they let you borrow $70,000, and at very low cost, 3% simple interest that you don't have to make payments on unless you sell the property. And I've seen some of my buyers buy those properties. Like, I remember one of my clients bought a 470 property, beautiful property, big, for $470,000. This is a few years back. But they're only making payments on $400,000. Does that make sense? Because they got $70,000 from the down payment assistance from the county, and then they put, I think, 3% down on that one, on that particular one. But anyways, whatever was left, somewhere around $400,000, they're just making payments. So their payments are a lot lower. So they're able to buy a bigger home with lower payments because of the county program. So I've seen those county programs really benefit home buyers. Question, Anita works with a private, yeah, so she's a private direct lender. Yeah, so now every private direct lender is different. They're not all the same. It's almost like Wells Fargo might not have that same program that Bank of America has with the down payment, or Navy Fed might not have the same program that potentially SDCCU offers. So every private direct lender is different as well. So it all depends on, each individual private direct lender, I would definitely ask your private direct lender if they have access to those programs, and that way you could find out, individually. All right, great question. I don't know if there's any more for loans, but I'll just move on, and if there is, you could just ask and we'll touch it later. Good question. We have another question. Do interest rate changes as well? Yeah. So anytime you borrow money from the county or from state of California or city or any of these down payment assistance programs, the interest rate is usually higher. The fees are usually higher. So I'll give you this example, this analogy that I use. Anytime you use all cash and buy something all cash, it's always going to be less money and less expensive than financing. Anytime you finance anything, whether it's a car, whether it's a house, whether it's some shoes from the mall, there's going to be financing fees. There's going to be interest rate. There's going to be, interest charges that you pay. So it's always really good to, if you have the money, use the money, cash. If you don't, then borrow it, But the question, I guess, was geared towards depending on private direct lenders. So the interest rates changes. Yes.
Yeah. And I also wanted to add, can you hear me? Yeah, I'm on mute, right?
Yeah, we can hear you.
When you get qualified, the interest rate they offer you there, that's the interest rate that day. So if you wait like 6 months to start the process of purchase, the interest rate might change then, because interest rates change every day. So not unless you get your offer accepted and lock in the rate, that's the rate you get.
Yeah, great point. A lot of people, get quoted, 3%, and then by the time they find a home and they lock it in and they go into escrow, that's when your lender could actually lock in the rate. It might have changed. Now, the economy changed, something happened with something in the world, the federal government raises interest rates. Now they're offering you a 4.5%. And now you don't qualify for 500,000 anymore. Now you only qualify for 400,000 because interest rates jumped up so much. So rates are up and down every single day. As far as private direct lenders and different banks, everybody has different rates. They're all pretty in line, but I've seen banks have, or private direct lenders or banks or whoever offer different rates on the same loan product. Okay. Now, I guess that begs the question, should you be, no one can lock in a rate. Good question. Can a private direct lender lock in a rate? Nobody can lock in a rate unless you go into escrow and find a house. That's when they can lock it in. So if you meet with a private direct lender or a big bank or a broker today, and they quote you a 3% rate, then you go out and look for homes, and 30 days later you find a home, that's when they can lock in the rate. They can't lock it in today when they're pre-qualifying you. So no one's able to do that. It's dictated by the market. So I think that's a really good question. And a lot of people don't know how that works, and they think they're going to lock in the rate today when they're getting approved, when really it's once they found a house. Good questions. Yeah. I appreciate the questions. Keep them coming. All right, let's go on to the next part here. What's included in your mortgage payment? Good question. Principal, interest, taxes, and insurance. So back in the day, when I first started real estate, 18 years ago, your monthly payment for the most part included your principal and your interest. And then buyers back then wanted to pay separate their taxes and insurance. That's only for pros, I think, and people who are super organized and really invest well with their money. But if you're a first-time buyer, or even like me, small-time investor, I really prefer just having all-in-one. That way, I won't have to make 3 different payments to the insurance company, to the property taxes, and then to my bank. Okay, so your mortgage payment is going to include all these things. Okay. And Claudia, I'm not able to really see the chat unless I open it up. So if you see a question pop up, just let me know, okay? cost of financing a home. So when you buy a house, you have the price tag, you have the down payment that you need to come in. You know, sometimes it's 0 down, sometimes you can put up to 30 or 50% down. The interest is the cost of borrowing money, closing costs. So one thing that a lot of buyers don't understand is when you buy a home, you're gonna have closing costs. What does that mean? Is that the same as my down payment? No, it's not the same as your down payment. Your down payment is part of the purchase price that you're putting down. That way you're telling your bank, hey, look it, I'm gonna put in 5% down. You're gonna put in the other 95%, right? Yeah. So you put in 5%, the bank puts in 95%, and you got yourself a house. However, there's fees and there's closing costs when you buy a house. So those are extra money that you need to have to buy. And a lot of people don't know that. They just think they need a down payment. So why the extra fees? Why closing costs? Well, because there's all kinds of parties that come together just to close one real estate transaction. You have your escrow company, title company, there's lender fees. You know, borrowing money isn't free. There's real estate fees, notaries, there's HOA fees. So all these fees combined, and we might want to change this, Claudia, but it's 2 to 3% of the purchase price, okay? So if you buy a $400,000 home, you're looking at about $10,000 just in closing costs alone. And that was to add on to Edward's question about the benefits of using those home builders. Is the home builders, and again, really any company could do this, but whenever you go buy a house, if let's say a $400,000 townhome, your closing cost is 10 grand, your down payment is 15,000. So 15,000 for your down payment plus 10,000 for closing costs. That's $25,000 that you have to bring in just to close a deal. Well, your closing costs, there's different ways to finance it. You either bring in the 10,000 cash, or you tell your lender, hey, raise my interest rate, and then you pay for most of it. Or you tell your real estate agent, hey, go negotiate that with the seller and just tack it on. So instead of paying $400,000 for a home, you pay $410,000 for a home. The seller credits you back 10 grand, and then you're left with $400,000 in your pocket. Does that make sense, guys? So that's how closing costs work. So what percentage do agents get from the purchase? Awesome question. So it depends. Every house is different. So the way that your real estate agent gets paid is something like this. Pretend there's 6 houses on the same block, right? And you're like, okay, I want to walk into house number 1. House number 1 might be offering your realtor, your real estate agent, 3%. Meaning, if you buy house number 1, your realtor gets 3% commission, right? You walk into house number 2, that seller might pay your real estate agent only 2% commission. You walk into house number 3, that seller of house number 3 might be offering your agent 4% commission. So that's a good question, Nelly, because if you were the realtor, which house would you want your buyer to buy? The 3% house number 1, the 2% house number 2, or the 4% house number 3, right? And I think most realtors would want them to buy the house number 3, right? So that's why you need to get yourself a realtor that explains the process and how they get paid, and that they have a good fiduciary to you. Because what I've seen in the past, I've seen a lot of realtors push their client to house number 3 because they're going to make 4% commission. But house number 2, which is offering 2% commission, might be the best house, the best price, the best built, and overall the best for the client. But the realtor says, geez, I don't want to sell that one because I'm only going to make 2%. And I've seen houses that only offer like $1,000. I've seen like flat fees where it's like, okay, we're just going to give you, $1,000 to sell this house, or $5,000 to sell this house, which in a lot of cases, like 1%, like less than 1%. And I've seen realtors steer their clients away from those houses. Why? Because they don't want to make $1,000 or $5,000 because the average realtor only sells 4 homes a year. Okay, so as a consumer, as a home buyer, you want to know up front how your agent gets paid, and you want to know that they're going to show you every single house on the market, not steer you into a house that's giving them a higher percentage, but you know you're losing out on, you're paying more for that home than you would have before, or anything like that. So you just wanted to be on the up and up. Great question. Thanks a lot for that. The next question: does the buyer ever have to pay a realtor? Yes. So there are several situations where that happens, or could happen. Does it happen often? No, it doesn't happen often, but it can and it does. So for example, if you hire a real estate agent and your real estate agent says, hey, Guillermo, I get paid 3% on every deal. Okay, that's my fee because, you know, I'm gonna do the best job for you, and I have all these different consumer programs that you're gonna benefit from, and I know the market, and I'm gonna work really hard for you. So I get paid 3%. So what is that gonna do? So let me finish. So the realtor tells you, Guillermo, if the seller of the house you choose isn't paying me 3%, I'll take whatever the seller pays me, and then you would pay the difference. So that type of deal does happen. And what it guarantees the consumer, the buyer, is that that realtor is going to show you every home on the market. And the realtor is not going to matter whether you want to choose the 1% house or the 4% house. To them, it's the same thing because they know that you're going to pay them the difference. But again, that's pretty rare. It doesn't happen too often, but it has happened. It does happen from time to time whenever there's a seller that really doesn't want to pay a fee or commission or anything like that. So I hope that answers your question. All right. So that's cost of financing a home, guys. Any questions? We're done with step 1. If you do, put it in the chat box. So now we're going into step 2. So a real estate agent's going to email you properties that match your home buying criteria from all real estate companies. Okay, so basically you tell your realtor what you're looking for. They enter it into a search program. So a lot of you guys are familiar with stuff like Zillow, Trulia, Redfin, Realtor.com. Okay, what they're doing, those companies, they're pulling a list of homes for sale from something called the multiple listing service. So there's 21,000 agents, 21,000 realtors in San Diego. All 21,000 realtors, they subscribe to something called the multiple listing service. So anytime that they get a new house for sale, they have to, okay? It's in the contract. We have to upload it to the multiple listing service. So the multiple listing service has all the houses for sale. So as a buyer that's working with a realtor, you're going to have access to those to all 21,000 realtors listings for sale. Okay. Now, Zillow, Trulia, Redfin, they're third-party subscribers to the multiple listing service, to the MLS. That's what we call it for short. So when you're online looking at homes on those websites, you're basically gaining third-party access from the multiple listing service through Zillow or through Redfin. So why is it free to a home buyer? Well, the reason why it's free is because they take your information and they resell it, number 1. Number 2, they charge advertisers to advertise on their website, knowing that you're going to be on there. So what's the difference between getting homes directly from a realtor and getting homes from places like Redfin and Zillow and Trulia? The difference is just accuracy. So with a realtor, you get first party access directly through the realtor's MLS, you get all the homes, and as soon as they're not available, they get removed. As soon as they hit the market, you get an instant email. Where Zillow and Trulia, they're a little bit slower as far as receiving the properties, and then they usually don't take the properties that have sold off right away. Why? Because they want more eyeballs. They want to be able to sell more ad space. So they want you on their website looking at homes that already sold. So you could click, and they could sell more ads. So that's kind of how it works as far as the access. But anyways, when you have access to MLS, you have access to all the properties, including short sales, foreclosures, for sale by owners. And then usually, you tell your realtor which ones you're interested in, and then you start to investigate those properties. Or your realtor starts to investigate those properties that you choose to see if it's a viable option for you. Step 3. So you want to work with someone who knows the market and knows leading edge technology, that has leading edge technology. So this is an appreciation chart. So this is San Diego over the last 30 years or so. You see how the real estate market is like up, down, up. Right here, it's like little peaks and valleys. Huge valley here, just drop, and then a little peak, dropped again, and now we're on our way up. So what are we looking at here? Why are we talking about this? Well, it's important to understand where you're buying in the home buying process. Okay, well, sorry, in the real estate market. So we talked about interest rates. Where are you getting your interest rate? You're getting at all-time lows. Prices. This is an appreciation chart. Where are home prices? Prices are up, all the way up. Okay, so we're at all-time highs as far as real estate. So a lot of buyers say, well, should I even buy right now? Should I just wait until there's, the market corrects himself? Or like a buyer emailed me earlier saying, I'm just going to wait for foreclosures. Well, that's the thing. Nobody can predict the future as far as what's going on with home prices. But will real estate drop again? Yes, it will drop. Why do we know that? Well, because it's proven throughout history. It's always ups and downs. But historically, it always goes up. And real estate's a cycle. It always repeats itself. So there's going to be a correction. We don't know whether the correction is going to be next month or 5 years from now. We just don't know. Okay. We have a question here. The question is, how does a realtor get a listing? Example, another realtor has a property you want to purchase, but the realtor you're working with doesn't have that listing. How can you, realtor I'm working with, obtain that listing? All right, good. Thanks for that question. Appreciate it. So whenever you're a member or a subscriber to the multiple listing service, to the MLS, like all 21,000 realtors in San Diego are, you automatically have access to that other agent's listing. So it's part of our contract as realtors in San Diego is that you have to give other competing brokers and agents access to your listings. Okay, that's just part of the deal. So if, let's say you're working with me and there's a property listed by Pacific Sotheby's Realty, right? And Pacific Sotheby's has this really a nice property that you want to see. We have something called reciprocation, where I'm able to contact that agent, ask about the property, make an appointment to go look at that home. And if we like it, I'm able to go ahead and write up an offer. And then from there, the good thing for that agent is that his seller wants to sell it. We got a buyer, and we're able to potentially put a deal together. Now, if the question is more technical, where you're saying, well, how come you specifically don't have that listing? Well, it just comes down to, that's like more of a marketing question or whatnot. So the way listings are even taken is there's a home seller that has a need to sell their home, and they reach out to a real estate agent. Sometimes that real estate agent is a friend, a family, maybe the agent who sold them the home 10 years ago. Maybe they found them off an ad on Zillow or something. And then that seller hires that listing agent or that seller's agent to help them sell the property. And that's when the seller's agent says, well, I don't have a buyer for it, so let me put it on the multiple listing service like I'm supposed to, and then let any real estate agent up from take your pick from all 21,000 in San Diego, bring us a buyer for this house. So that's an awesome question. I hope I answered it. I could go into more detail if you like. All right, so all right, here we go. So the next thing we need to look at is inventory levels. So guys, check this out right here in the red. This is the inventory in San Diego. Right now we're negative inventory. What does that mean? That means that there aren't that many sellers. And right now there's not enough supply of homes. There's more demand. So buyers and then sellers. There's very little sellers and there's a high demand of buyers out there. Yes, Claudia?
How'd you know I wanted to say something?
Yeah.
The caravan this morning on the pitch session said that we had 3 months of inventory. So if today there was no new listings, just 3 months worth of inventory. Can you hear me?
Yeah, I can hear you. Yeah, no, that's good information. So what that means, 3 months of inventory, that means that if not one new home came on the market within the next 3 months, we'd be out of homes in San Diego. Right now, there's about 5,000 homes for sale in San Diego, 5,000. So just to give you an idea, because I get this all the time, I'm gonna wait for prices to drop. I'm gonna wait for closures to come up. I'm gonna wait for more inventory to hit the market, for the market to crash. Right now in San Diego, there's 5,000 homes for sale. 5,000 sounds like a lot, but during the crash, during the Great Recession, 2008, there was 14,000 homes for sale. So back then there's 14,000 homes for sale. There wasn't enough buyers for 14,000 homes, so prices tanked. Right now there's only 5,000 homes, and we got way too many buyers for 5,000 homes, so prices are strong. Just so you guys have an idea on how that supply and demand works. Okay. Do you ever show houses before they hit the market? Can you repeat that? Okay. Yeah. So do I ever show houses before they hit the market? We used to, yes. There's a new rule that came out June 1st. Was it June 1st or May 1st? May 1st. There's a new rule that came out May 1st that said any real estate agent in San Diego County, again, there's 21,000 agents, that they can no longer have what we call pocket listings. They can never have a listing and not advertise it to everybody out there. So that's a brand new rule as of a month ago. So if, let's say I had a listing and I had it in my pocket, nobody knew about it, I can't advertise it and I can't show it to my buyers at all. It has to be fair. So the moment that I offer it to one person, I have to offer it to the entire marketplace. So again, we used to do that, but there's a new rule that came out that governs every single real estate agent in San Diego that says that you can't do that anymore. So as soon as we offer it to one person, we got to offer it to everyone. So can you repeat that? I'm assuming you're talking about the inventory. So 12 years ago, when the market crashed, there's 14,000 homes for sale. Right now, there's only 5,000 homes. Yeah, 3 months of inventory. So yeah. So what that means, as far as 3 months of inventory, means that if today, June 2nd, there isn't one new home that comes on the market, not one new seller decides to sell their home, 3 months from now, September 2nd, we'd be out of homes in San Diego. All the homes would be sold. So that's what 3 months of inventory means. We're a normal market, so what that means is it's a seller's market right now. In a buyer's market or in a normal market, there's 6 months of inventory or more. But right now we're only at 3 months. That means that the sellers have it really good. Do you still sell fixer-uppers? Yes. There's a bunch of fixer-uppers out there. They're just they're all over the place. So there's a lot of fixer uppers, and the thing with fixer uppers is that your loan has to qualify for it. In your slide, what does the red bars above the 0 line horizontal represent, and the blue lines below? Great question. So the red line means negative inventory, negative supply. These are months of inventory, negative inventory, and then the blue is positive inventory. So that's kind of what that means is there isn't enough homes, basically, supply. Out of every 10, great questions, by the way, out of every 10 offers on the market or buyers on the market, this is kind of the breakdown. 0 down VA buyers, about 20%. And then if you combine FHA with government assistance programs and conventional, under 20%, like first-time buyers, that's the other 40%. And then,
sorry, Walter, gotta interrupt that.
Hey,
No,
Edward.
the previous one, I was actually pointing out there's a red bar that's above, which is supposed to be positive, is it? But it's red, not blue.
Where, right here?
Yeah, is that? I'm seeing red. Is that?
Red is bad when it comes to inventory, meaning the supply of homes for sale. So this is an inventory level, meaning that how many homes there are on the market. So right here, it's negative supply compared to the demand.
Also the color. Okay.
Yeah. So the blue meant, and great question. The blue meant.
Right. It's blue and red and same.
That means that there's positive. Yeah, there's positive supply, and it was a buyer's market. So the red just means it's a seller's market, basically, because they get to choose their price.
Mm-hmm.
Yeah, great question. Anything else there? Any other questions there, Edward?
That's good.
Okay, awesome. Thank you. Okay, so right now, so we all have an idea is 60% of all buyers are first-time buyers, let's say. Then the other 40% of buyers out there are second-time buyers or cash buyers. So this is a crazy stat for you guys to kind of check out. 20%, 2 out of every 10 houses that sell to a cash buyer. Historically, in San Diego, we're at about 13% of all buyers are cash. So almost 1 out of every 10. So we're now 2 out of every 10. Just so you guys have an idea of how much, I guess, how busy it is and why houses stay so strong is because most buyers out there are buying cash. Well, not most, but 20%, which is a huge chunk. So this is just so you have an idea of who your competitors are. All right, so what's the next question? Does more inventory mean higher rates? Good question. I gotta think about that. Does more inventory mean higher rates? No, it doesn't. The rates are governed by the Federal Reserve, the government, how much percentage they loan to the banks at, and then the banks in turn lend to you. But as far as direct correlation, no, none that I could think of. Next question, what could be the advantage or disadvantage from buying a fixer-upper home to a move-in ready? So the advantage is you get a better price. You have something called sweat equity when you buy a fixer. That's the advantage. Why? Because, you know, a home that fixed up is worth $600,000. If it's a fixer, let's say you buy it for $530,000, but you need to spend $40,000 in work to fix it up to that $600,000 price. So you buy it for $530,000, you spend $40,000, so now you're only paying $570,000 for a home that could be worth $600,000. So right there, you have something called instant equity. The tough part is getting it fixed up because now you become a contractor. Now you have to spend time and energy, and it's a full-time job being a contractor or hiring a contractor, and then just staying on top of that contractor. You can't live in the home for 2-3 months, depending on how the remodel, how extensive it is. Now, when you say a fixer-upper, my definition of fixer-upper may be different to your definition of a fixer-upper. When someone tells me fixer-upper, I think, the house is about to fall down. If the wind blows it, in a certain direction, or the wind hits in a certain direction. Most first-time home buyers' definition of a fixer-upper is like, it needs paint and carpet. So if you buy a house, paint and carpet, you're not going to get a huge discount, but the advantage there would be that there's a lot of buyers out there that don't want to even touch the carpet, touch the paint. So therefore, you're able to potentially buy a property where others are passing up on it. So you have less competition. And another question is, do you advise the buyer if there are any existing code violations? Great question. That's like a advanced question, actually. Most first-time buyers don't know about code violations. So the seller usually discloses whether there's any violations, okay? Number one. It's California state law. The seller has usually 7 days according to a contract to tell you what's wrong with the home if there's any existing code violation. If they neglect to tell you, whether because they don't know or they're lying, then usually the title report picks it up. Okay. So the title report is done in escrow once you're in escrow on the home, and it's usually recorded on there if it's a legit code violation. But before any of that, usually when we go out to the home for the very first time, through our experience, we're able to recognize things that first-time home buyers don't know, and then we could point out some things like, hey, that might be a possible violation. This may not be permitted, etc. So it all starts off with that first walkthrough of the home, and then after that, then the seller, if we get into escrow, then the seller tells us if there's anything wrong, and then title tells us what they found, and then also that's part of your due diligence period during escrow. We feel that there's an issue, then we would tell you, hey, look, this is the Development Services Department down in the city of San Diego or the city of Chula Vista or wherever. Go in there and check, because technically your real estate agent cannot check for you for liability issues, but we're able to just kind of walk you through it and show you how to do it. Great question. All right. So types of listings. 83% of all listings out there for sale, all properties for sale, are traditional sales. Okay, what does that mean? That means that they're selling and they're not in any, they don't have any issues. They're not in any distress. So 83% of all home sellers are not in distress. That means that they're selling the house because they want a bigger home, their family's growing, so they need that extra square footage or bedroom, or they're selling because the house is too big for them, the kids went off to college, so now they're selling for personal reasons. They want a different neighborhood, better school district, but they're not in distress. 17% of home sellers have some type of distress. Either they're doing a foreclosure, a short sale, or a court order sale. What's a court order sale? Someone's suing somebody, someone's getting a divorce, someone is passed away, the family's selling. So that's kind of what a court order sale would be. Sometimes, well, we need to get rid of the slide. Sometimes we had off-market properties. That's no longer the case after that new rule. Step 5, closing transaction quickly with the least cost and hassle. So there's a difference between selling by yourself and selling as a team. I'll give you a quick background on this. Reason why we have this is when I first started in real estate 18 years ago, it was just me. And I had a good amount of clients, and the problem was I couldn't be at 2 places at the same time. So a buyer wanted to see a home in Chula Vista, and another buyer wanted to see a home in Mira Mesa. I couldn't show both clients if it was a Sunday or if I was sick. I couldn't host that open house for my seller. So I was an individual agent, and 99% of agents are individual agents. They work alone. They don't work as a team. Then I found the team concept, and team concept was like, hey, we're on the same team. Everyone has a specific job. It's more efficient, way better customer service. We could cover the entire week, Monday through Sunday. I think Claudia just went to go look at some homes right now with a client. Monday through Sunday, nights and weekends, mornings and all that. So anyways, when you choose someone, your call, you can have a full team with better service, better processes, or you can go with an individual agent. I mean, back then I was good, I like to think, but I did drop the ball on a lot of things and could have done better. All right. Your agent should have some type of goal for you. Help you secure the best financing by introducing you to the right people, by right lenders, negotiate the lowest price and terms for you, and then meet your home buyer needs with the least amount of hassle. A little bit about us, top 1% agent in the county for the last few years. I've helped hundreds of agents. I put on workshops for hundreds of realtors to teach them how to do better business. Been on the radio, been on TV, wrote articles in the newspaper. And then usually we're able to help the buyer find a home faster than the average agent. Okay, this is the important stuff right here. This is the escrow timeline, okay? So what's the escrow timeline? Well, the escrow timeline, let's start off with what's escrow, who's escrow? So escrow is a third-party company. Why do we need escrow? Well, this is what escrow does. So by the way, when people say, hey, I'm in escrow, what they mean is that if they're a home buyer, they're no longer looking to buy a home, okay? That's what that means, because they found a home and now they're in the escrow process. To be in the escrow process, you have to hire an escrow company, okay? And this is another closing cost. You have to pay your share of the escrow company, okay? So the way it works is, let's say you go out there, we're looking for homes, we find the perfect home, we get it into contract. Well, once we're in contract, that's when the timeline starts, okay? So in this example, I'm using a 45-day timeline, 30 to 45-day timeline. So day one, that's when your offer gets accepted. That's a contract start date. Within 3 days, you as a buyer, you have 3 days to put in your initial deposit, okay? So your deposit could be anywhere between $1,000 to $50,000. So it just depends on how many times you bought a house, how hot the property is. When I really try to get a really good deal for myself personally, I put a $25,000, $30,000, $40,000 deposit. It just depends on the deal. In your case, as a first-time home buyer, you're probably going to put at minimum 1% of the purchase price. So if you're buying a $500,000 home, you're going to put a $5,000 deposit. That's normal. If you don't have, so what is a deposit? Deposit is just something to hold your spot. It's your money. You're putting that deposit into escrow, and you're telling the seller, hey, Mr. Seller, I'm serious about buying your home. I'm going to put this deposit in escrow just to show you I'm serious. And that way you can feel comfortable with taking your property off the market for me. So that's what a deposit is. That's what a deposit does. And I've closed deals with as little as $100 deposit, which are tough to explain to a seller why you only put in $100 in the deposit. And I've done deals with hundreds of thousands of dollars in deposit. So it varies. So you have 3 days to do that. Within the next 7 days, or within the first 7 days of the transaction, the seller has to disclose to you everything that they know that's wrong with the home. Leaky roofs, someone passed away in the home 2 years ago. The neighbors are always throwing parties and they have banda and you can't sleep Saturday night. So anything that they know that's wrong with the home, or that's maybe a neighborhood nuisance or material fact that would cause somebody not to want to buy the home, by law, California, you have to disclose that to the buyer, okay? Within 10 to 17 days, that's the buyer's contingency period. What's the buyer's contingency mean? Contingency is your right to cancel the transaction. So if you're a buyer, you have the right to cancel the transaction. You don't have to buy this home. Just because you wrote an offer on it, you liked it, and you put a deposit in, doesn't mean that you have to buy. You could always cancel. That's called your contingency. It means your right to cancel. You have several different types of contingency. You have one for your inspections. So in a typical offer, let's say there's 3 contingencies right off the top of my head: inspection, an appraisal contingency, and a loan contingency. So your inspection contingency, you tell the seller, hey, I need 7 days. Well, let's say 10 days. I need 10 days to inspect your home. That's what I want my inspection contingency, 10 days. And I want 17 days for my appraisal contingency. And I want 17 days for my loan contingency for me to figure out that for sure I'm gonna get this loan. If I don't get the loan, I could use my loan contingency to cancel the transaction and keep my earnest money deposit. Same thing with an appraisal. If the property doesn't appraise at the price that we're in contract in, then I'm able to use my appraisal contingency to cancel and keep my deposit. That's what a contingency is for. So typically in a normal transaction, you have 17 days to remove all your contingencies and basically tell the seller, Mr. Seller, I already inspected the property, I already did the appraisal, I already did the termite, and I already talked to my lender, my loan's good. I'm removing my contingency to the 17th day. If I cancel after today, then you can keep my deposit. And then most of the time, most buyers move forward and close on the 30th day. After they remove the contingency, they move forward and close on the 30th day. It's very rare, very, very rare that someone removes their contingency, moves forward, doesn't close the deal, and then loses their deposit. Okay. Now, what inspections do you do as a buyer during those first 10 days, let's say, or 17 days? Well, you have your appraisal. That's this is actually a little bit older and accurate. The appraisal is going to cost you about $550 ballpark. The home inspection, $350 for a condo, $450 for the average house. If you're buying a 5,000 square foot house, then that home inspection is going to be closer to like $1,000. Just depends on house size. And then the termite inspection is about $100. Most of the time, the seller covers that. Sometimes they don't. So all in all, these are out-of-pocket expenses that you're going to pay as a buyer. You're never going to see this money again. Okay, whether you buy the house, whether you don't buy the house, you're never going to see your out-of-pocket expenses because you're paying for people's time to go out to a property and educate you on the physical condition of the home, educate you on the appraisal value or for your bank, and then on the termite potentially. All right, so we have some questions. All right. All right, so do you get the deposit back in the contingency period? Yeah, if you cancel within your contingency period between those 10 to 17 days that you have, you get your deposit back. You don't lose that. How often do the price change from the information that the seller discloses? If so, when does that happen? So how often does the price change with the information that the seller? Oh, okay, good question. So the question is, how often does the, let's say the seller disclose something that you didn't know before? You go into escrow, you love the place, and then within the first 7 days, the seller says, you know what, by the way, it leaks, the roof leaks every time it rains. And then at that point, you're like, really? Then you get a roofer out there, the roofer checks it out, and you're like, shoot, the roofer says you're gonna need a new roof. How much is a new roof? 12 grand, let's say. Now at that point, you go to the seller and say, hey, I bought this property thinking that, you know, my clothes wasn't gonna get wet when it rained, so I needed to be in operating condition. I need a roof to be in operating condition. Then from there, the seller might say, well, you know what, you just need to make a patch over here and a patch over there and you're good. And it should last you another 5 years. And if that's the case, then, you know, they do those repairs. Or if that's not the case, let's say you're not going for that. The seller says, hey, look, I'm going to give you credit. I'm going to reduce the price by $12,000. And either, you know, at the close of escrow, you could either fix it later, or you could just, you know, have your uncle do it for half the price or whatever. I don't care. I'm going to discount money. So you could negotiate during this time. You could renegotiate the terms that you already agreed to based on the condition of the home or based on information that the seller provided to you. Next question. And by the way, just to give you an idea, during escrow, usually you can negotiate some credits for yourself for repairs. And I think the average right now for a house, about $2,000. You know, I've seen $0 negotiated. I've seen $50,000 knocked off the price, you know, after inspection. Question is, would it be safe to say that $10,000 to $15,000 will be safe to have for escrow? Is your question for a down payment or just a deposit? Because down payment or to purchase a house, $10,000 to $15,000, you should be able to qualify for some type of program to be able to buy, depending on the size of the home. I mean, there's condos right now you can buy and put $10,000 down, another $5,000 towards your closing costs, so $15,000 should cover that. Yeah, for all closing costs. Yeah, so closing costs, if we're not talking even about down payment, just closing costs, yeah, you'll have, again, that average closing cost is somewhere between 2 to 3% depending on the purchase size. If you're buying $1 million home, closing costs might be, you know, 15 to 20,000. If you're buying $500,000 home, closing costs might be 10 to 13,000. It just depends. So yeah, you're good with closing costs 10 to 15 grand, but it all depends on the size of property and everything. So all right, great question. That's going to be here, the escrow timeline. Any questions on the escrow timeline? All right. Let me see, do we have anything else? So we happen to offer a buyer satisfaction guarantee. What that means is if you're not satisfied with your home within 23 months, we'll come back. We'll actually help you sell the home. We won't even charge you a commission just because we want you to be happy as far as your purchase. Nobody in town does this from what I know, but it's just to make sure that way you're aware that we're not going to push you into a home that you don't want. That's something that we have here. But what questions in general do you have about the home buying process? Anybody, if you're out there, this is a time to ask. I know one thing that we didn't cover was, you know, the whole credit, the whole loan, but that's it. So, I mean, we did cover the loan, but not the credit side of things. That's more of a lender thing. But guys, thanks for jumping on. And again, the home ownership here, I'll just leave you with this. So you guys have an idea of how important it is to own, especially for long-term generational wealth. In America, the history behind owning home ownership is since the 1930s and 40s and 50s into the 60s, it was just, hey, if you're white, you could buy houses, you're able to get loans. And then it changed with the civil rights and all that stuff and discrimination. Then they started letting other people get loans, right? And, but just until recently, they started doing it to where they opened it up to where you could come in with 3% down. You could come in with 0% down. Up until the 80s, they're redlining. So what they would do is they would draw circles around certain neighborhoods saying, within this neighborhood, we're not going to give loans out, right? And that was common practice. So if you're a minority and you're trying to, you know, buy real estate, and you know, up until the 50s, you couldn't even live in the neighborhood you wanted to, and it was in the deed saying that you couldn't buy in North Park. You know, I read a book about the first minority in the Tendwell City Council, a Chinese guy, and he had to door knock all his neighbors to get their cosign for him and his family, Chinese, to move into a house here in North Park. So there's all kinds of discriminatory practices. So the reason why I'm so passionate about this, and I urge you guys to get into real estate, is because that's the only way to catch up, is through home ownership and property ownership. Because all these years they kept us, the U.S. government kept us, people like us, from home ownership, and that's how powerful it is. That you know, we're at a disadvantage, and but you know, regardless of what color, creed, or whatever, hey, you guys should definitely invest, because that's how powerful it is. If they had all these discriminatory practices from you preventing minorities from owning, that means that they knew was how powerful real estate could really affect and impact your life and generational wealth. So that's what I'll leave you with. You know, best of luck. If you have any questions, feel free to reach out to us. You know, I have some questions. Can you recommend us to direct lenders? Of course we can. My credit isn't the best. Cash on hand. Is it better to work on my credit, such as paying off debt or putting cash down? I would say work on your credit. The better credit you have, the better interest rate. And we have people that could help you with your credit. So reach out to me directly. I'm gonna type in my email here. If you guys have any questions, call me. I'm gonna type in my phone number. Any questions, call me. Hey, Guillermo, you're welcome. Thanks for joining. What's acceptable credit? Great question. Depends on the type of program you're getting. You could have a 580 FICO and you could buy a house. You have a 600 FICO, you could buy a house. Thanks, Edward, you too. But I will tell you this, the higher credit that you have, the better. So whenever I go to buy real estate, and I buy 1 to 2 properties a year, that's usually what I try to do. Right before I know I'm gonna buy, what I do is I pay off my debt. They run my credit score, they run my credit, my FICO jumps up usually. So usually my FICO is around a 714. And then as soon as I pay off my debt and that reports to the agencies, it jumps up to about a 740, 750. And the reason why I do that is because that difference between, you know, 714 FICO to 740 to 750 FICO is huge. So the same thing works if your FICO is 580. If you bump it up to 620, 640, then all of a sudden your interest gets better. You save money over time. Great questions. I really appreciate you guys jumping on, man. And it was a pleasure. Thanks for all the awesome questions. I haven't talked about some of that stuff in a while. So thanks again. There goes my phone number and my email. Best of luck, guys. Thanks for joining us tonight. See ya.